Hello, traders. Gary Wagner here. It is 12:33 in Honolulu, 6:33 in New York on Thursday, 14th day of July, 2022, and this is the Daily Report for gold and silver. Investors are still digesting yesterday's CPI report, coupled with the PPI report today, confirming that inflation is running exceedingly hot, and it will force the hand of the Federal Reserve to change their current aggressive monetary policy to a much more aggressive policy. Gold today lost $27.50. It is currently fixed at $1,708, but it did briefly break below $1,700, trading to a low of $1,695. It opened at $1,733.60, and the high was just about a dollar above that at $1,734.80. The net decline today was about 1.6%. Silver got absolutely hammered, losing 4.5% today, now well below $18, with the September futures contract down 86 cents and currently fixed at $1,833. Dollar strength contributed partially to the massive declines in the precious metals markets. However, it was selling pressure that overwhelmingly was the major force moving the precious metals lower. The dollar gained approximately 0.7%, a total of 0.719 points, and is currently fixed at 108.475. Yesterday's CPI report, coupled with today's PPI report, definitely infer a dramatic, more aggressive move in the Federal Reserve. That changes everything when looking at things such as value of the dollar index, gold and silver pricing, and yields on debt instruments. That means we have to reanalyze the technical numbers that we have been looking at. We have clearly broken below 1720. That was our next target for potential support, which takes us to our current target. Currently, there is minor support at 1696 to 1700 for two reasons. The first reason is that it is the 61.8% fib retracement of a much longer data set. This begins at the beginning of 2020 when gold was trading at $1,454 up to the record high of 2,088. You get the 61.8% retracement at 1696. And of course, 1,700 is also a key psychological level. Below that is 1680. I'm rounding it up slightly, and that matches with the low of the flash crash that occurred last year in August, as well as a series of lows that occurred at the beginning of 2021 and a cluster of lows that occurred in April and May of 2020. Below that is 1600 and 1593, again, a key century mark that corresponds to a relevant Fibonacci retracement number, this being a 78% retracement, and that would be the level that we would look for gold to go to if it breaks below 1680. I believe that we still can say that 1680 is major support. However, with the possibility that we will have interest rates as high as 3.5% to 4% by the end of the year, it is a game changer in terms of evaluating and predicting where other asset groups might be if that comes into fruition. Lastly, I do want to look at the dollar because with higher interest rates comes a higher value to the dollar, because higher interest rates means that U.S. debt instruments have a higher yield. That makes them more attractive and brings more investor capital to that asset class. That, coupled with the fact that the opposite tends to happen in U.S. equities. They have been declining in response to raising rates, a contraction of the economy, and with a more aggressive stance, means that we could see further pain in U.S. equities. We will look at this tomorrow and focus intently on the repercussions of this week's PPI and CPI report next week. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for the weekly wrap-up and review. Bye-bye.